Welcome everyone to the panel entitled M&A Outlook for the next 12 months. Where are the key trends and opportunities we're seeing? Joining me, we have Mike Ahms, partner at Torrey LLP. Then we have, Charles Tung, Managing Director, Mining of Goldman Sachs. To his right, we have Todd Karpunke, who is the legal principal of mergers and acquisitions at Anglo American. And last but not least, we have Morgan Carroll, who is the EVP, Executive Vice President of Corporate Finance, General Counsel at Endeavor Mining. Welcome, gents. And I promise next time we'll have another woman on the panel. Okay, so if I'm reflecting on 2023, we've seen a substantial decline in mergers and acquisitions. But then in Q3, we saw a substantial increase. I think we went from just under $6 billion in mergers and acquisition transactions to 14 point something billion in Q3. Should we still be optimistic is really what I'd love to know. And in the past, mergers and acquisitions has always been led by just making a deal, but now we're seeing M&A transactions being governed by much more than what's behind the deal. We're seeing ESG and regulatory frameworks really guiding mergers and acquisitions, but we're also seeing geopolitical challenges. We're seeing the likes of the electric transition governing, where we're looking towards M&As. And maybe to start off, we should look to the investment banker to help us understand how should we see, or how do we see M&A activity levels going into 2024?
Sure. So look, I think the way to answer that question is to say there's definitely an increased willingness in the sector to think strategically, and that's driven by the energy transition broadly. So people are thinking, what do I mine? Where do I produce it? Who am I selling it to? Who are my partners? And that really has kind of, there is real kind of religion amongst management teams and amongst boards that the businesses need to be ready for that. I would say, it's not yet at a level where people are saying, I must go out and buy that asset, raise debt, spend cash. People are thinking, how can I do 1 + 1 and make 3? Is there something smart I can do with my portfolio? Is there a way that I can, create more value with someone else's portfolio? And you see that in some of the stuff that's playing out, right? So if you look at Vale, separating off their base metals business, if you look at the process that Teck is working through, those are the kind of sort of things that people are thinking about, is what's the way that I can really create value here and set up a company or a set of companies that are right for the future. And what I would say about those transactions is these are all big, complicated deals. These have multiple months, if not years, of gestation. So people are definitely thinking about it. People are working out how they can be positioned for the future. Do those all come through in 2024? Does it end up being 2025? I think hard for me to say. But there's definitely an increased willingness to step back and think strategically and make sure companies are set up properly for the future.
And part of that future is definitely being driven by the energy transition. And you give a great example of Vale, and I'm thinking of other companies where we're seeing more and more transactions along the energy transition lens, moving away from their traditional commodities more so towards battery metals, for example. And turning towards you, Mike, how are these large deals, or how is the energy and electric transition driving these transactions? What's the impact there?
Well, Stacey, I think it's the energy transition's a game changer for mining generally, as this conference would all agree with, I think. And it's no different in M&A. You're seeing the same types of forces drive it. And I'm going to give just a little bit of a view from my own perspective as an M&A lawyer and the types of deals that I see going on and that our clients are working on and contemplating. And so I think that energy transition is driving M&A and is going to continue to drive it in some very different and very interesting ways. You know, what are the metals that are going to benefit most that are driving this? Well, it's, as you'd expect, copper, it's nickel, lithium, cobalt. That's where a lot of this focus is. And what's also interesting is when you look at the types of M&A participants, it's a broader group than we've had before. We have, on one hand, sector players doing what sector players do. For example, they merge and consolidate. So maybe if you look at lithium and you look at Livent and Allchem coming together, that's a traditional sector-to-sector merger that is causing a greater, more competitive lithium, bigger player. Then you have some more interesting things. You have the majors looking at bulking up on future-facing commodities. And that's a shift for them. They're coming out of coal and energy, and they're tilting towards copper, nickel, cobalt, lithium. If you look at BHP, for example, it's Oz Minerals transaction. That's an expression of that trend. Then you have new entrants into both the mining sector and mining M&A, and those are the auto and battery sector OEMs. And you have the likes of GM for the first time looking at participating in significant projects with big dollars. They're not going to buy 100% of a mining company, but they sure are going to invest a lot in things like Lithium Americas, Thacker Pass. And you see that at the very large scale, and you see it at the lower level scale, where you have, for example, Stellantis investing in McEwen Copper, very early stage Argentine copper project. So it really spans the waterfront. And what we're going to talk about further is we have another category of buyer, and those are our Chinese SOE folks, and they're continuing to look around, but it's getting much harder for them. And that's part of this trend in the battery metals, in geopolitical reality. So this is quite interesting. It's quite different. And I think we're going to see this drive what's going on in the sector in 2024 and the years to come.
And Mike, you've made some really interesting points. One of them was, seeing majors bulking up on these future-facing minerals and maybe turning to one of the majors, Todd. What is Anglo's approach to these future-facing minerals?
I think Anglo's approach is the approach that Charles was mentioning, and kind of the way you think about things, and kind of what's going to make the most money for your shareholders, and kind of what kind of company you want to be going forward. So I think at our company, we have the future-facing metals business. We also have we call green steel, right, which is important for the energy transition. For example, windmills, and we also have a crop nutrients business that we're investing in, to kind of also address the food needs of the future, which is going to be a major issue for the growing population in the world.
And turning to the gold miner in the room, to Endeavour Mining. Endeavour's had a great story, in my opinion, especially looking at West Africa and how you have managed to expand based on a very interesting strategy that I'd love to hear about. But, we're talking about growth. We're talking about the transactions we're seeing from Endeavour. Could you give us your perspective on how can other mining companies looking at the region expand, and maybe what's your story? What's your growth story?
It's a long answer, I'm afraid. The easy answer is we started with a fairly blank slate. Endeavour was conceived as it was a startup, basically. It was thinly capitalized, and we went on a long journey that's taken us to where we are as a FTSE 100 currently. It took a very, very long time to do so. Well, in our view, it's taken us over 10 years to do that, be on that journey. There are unique things in West Africa, aside from just the geology, that make it very favourable to be successful from a gold mining perspective. Some of those are surprising social and governmental factors. Some of them are about the geology. Some of them are about the capital intensity or the cost of the capital intensity. So, for example, building in West Africa is allegedly a lot simpler than many other jurisdictions around the world. I think we've shown track record-wise, from Endeavour's perspective at least, we've been able to be successful in multiple project builds in multiple countries. The keys behind that are some of the common features that bind the West African countries together. So they're in a monetary union. They're using the same currency across West Africa. There's an economic and political cooperation that leads to mining codes being standardized as well, which makes it easier for miners to enter one country and then develop into another country, perhaps. Then we've seen great support from governments. A lot of the headlines in West Africa are about coups. They're about political risk. They're about unfavorable jurisdictions. They're unflattering headlines. But the fact of the matter is that throughout all that, throughout the difficulties that the region has experienced, and it's been long-standing, we have seen great support from regional governments for the mining sector, and that's because of the GDP contribution of the miners to the national budgets. But the relationship, the social license to operate piece, that we've been quite successful in co-opting with governments, stands you in good stead. It pays a huge dividend over time if you invest that energy up front. So we've been able to develop a business pretty much organically. I know we've been in the headlines for our M&A at times, but we've really believed that we are an organic business. And actually yesterday we had a press release which proves it. We've just released a press release which shows a mineral resource of increase of 300% at our Tanda project in Côte d'Ivoire. Fantastic geology, fantastic support from the government. I think what we would say is West Africa is a fantastic place to do business on the whole. There are debits and credits in there, but a lot of reasons for positivity.
300% increase, you say?
Pardon?
300% increase.
300% increase in our resource, which our initial resource, at about the same grade. Yeah. So it only illustrates the fact that growth is possible, and that's the lowest cost growth you can get. It's $11 per resource ounce that we've spent on it. So you can't get that in M&A. You can't get that anywhere. So it's a huge value driver looked at over the longer term.
So you're so successful in gold, but looking at the trends of certain gold miners maybe going towards copper, silver, would Endeavour think about exploring beyond gold in the near future?
What's clear from recent transactions, Newmont, Newcrest being the most recent, but of course there's a certain trend of larger gold miners having a toehold in copper, 20 to 30% of revenue factor, which is seen as the acceptable, I think, limits of not becoming a copper miner per se. It's attractive for a variety of reasons. Of course, it's a participation in the transition story, which is great. I think everybody wants to try and show their colours on the transition story. It's also a way to get scale. And what's difficult in gold mining is getting to scale and then staying at scale. And scale is important, lest we forget, the mining industry's been roundly criticised, and probably rightly so, by all the analysts for silly M&A deals and scale for the sake of scale and everything. But scale is really important for generalist investors. Generalist investors can't invest in smaller companies very easily. They need liquidity and they need scale. And copper is one way to get scale, but it needs to be strategically coherent as well, because going off and doing a large copper project, which is essentially an infrastructure project rather than an open pit mining operation, it's a different set of skills, and I think everybody has to be aware of that, including us. So I think, to answer your question, interested to watch what happens in copper. We don't need to do any M&A because we've got a great organic story.
Yeah, absolutely. But for those who are looking at M&A transactions, maybe turning to Charles, and you mentioned scale, which I think is important. But how are acquirers getting the generalist investors excited and supportive of these large-scale M&A transactions?
I think, look, what do shareholders want to see from M&A? I think, number one, does it make sense? Right? Is there? Can I see the rationale for this transaction? Forget the premium or the structure, whatever. Just operationally, does this make sense? Right? And that's it's important to come out and tell that story and show that why it makes sense and what can be delivered by this transaction. Number two, is this the right team to do this? So look, I love the idea. You've sold me on the dream, but there's a real concern about execution. Can I get from A to B? So what's the idea? Is it a good idea? And you need to persuade shareholders. Yep, this is the right idea. And then you need to have a team where the shareholders have the confidence that yep, this team can execute on that, and this is going to. It's easily achievable, right? Maybe picking up on some what Morgan was saying, about can I see? Sure, I'm going into copper or whatever it is, but there's a clear story that I know how to operate mines that look and smell and feel like this already. So it makes a lot of sense. And then, kind of to my mind, at least to some extent, the specific kind of premium or relative value, it kind of drops out of is sort of the final piece there, right? If the overall story makes sense, if it can be executed upon, then it's just sort of nickel and diming on, okay, well, where's the right level? And obviously, there will be a level that works and a level that doesn't work. In terms of how you build up that trust, I mean, my view is, conscious I'm not the person who has to do this, but don't surprise your shareholders. Get out in front of them early. Make sure they know, how you think about M&A, how you assess opportunities, and shareholders want to know that you think about them first. So, I run my business and I run it really well and I generate cash, and then, what do I do with that cash? Well, I've obviously I think about, can I give it to my shareholders? I think about them first. I then think about, I've got opportunities internally to spend money to grow my business, and obviously I look at other things externally, but I'm only going to do them if they make sense, if I can execute on them, and if they are better than giving money back to my shareholders or developing things internally. So I think that's the real sort of the key, is to get the story out there early in terms of how you think about it, and then when you do, as a corporate, decide to do something, you come out and say, look, here's this phenomenal idea. We told you before how we think about stuff. It ticks all these boxes. And then you have that sort of strong narrative behind it. And I think shareholders do realise, the mantra of maybe 5 years ago of don't do anything, just give cash back is fading. People realise you have to grow the top line to grow the bottom line. But they still want to see smart stuff. It's not just growth for growth's sake. People want to see stuff that makes sense and is executable.
Yeah. And part of that story, part of that execution story is really about telling that good story and looking at Anglo. I think it's a good segue to kind of understanding from a risk perspective and an execution perspective what's Anglo's approach to ensuring that these deals have a good story.
Yes, so whenever we evaluate any opportunity, we invest a lot of time and money into risk analysis, both political and ESG. We hire consultants. We have reports delivered. Sometimes we have numerous reports delivered that follow on, previous reports, just to drill down to make sure we have a complete picture of the ESG picture, to make sure that we can operate at the level that we want to operate at to our standards, right? Which often means a cost, which goes into the valuation of the deal, right? Because bringing certain assets up to the Anglo standard is quite costly sometimes, and that impacts whether or not we can do the deal. It's also important for us when we're selling. ESG is also at the front of our minds. To make sure that we're disposing to a responsible buyer, who will again, take forward the ESG concerns that we share. Makes any sense.
And we're seeing ESG as almost as the rationale for M&A, more so in certain jurisdictions than others, especially as we're seeing the rise of reporting standards and regulations around ESG growing, and I'd say especially in the EU and the UK. And maybe going back to you, Charles, it'll be interesting to understand whether, how this rationale of ESG is manifesting itself from the banker's perspective. So do you expect that ESG drive to continue in certain jurisdictions of seeing a swing the other way and not that much impetus put on ESG, but in others it's really a driver?
So maybe, I think on the ESG front, there's kind of two parts to it in my mind. There's, what you do and how you do it, right? And the kind of how you do it is sort of just a barrier to entry, right, for any industry. Like whatever I'm doing, I'm going to do it in the most socially responsible, greenest possible way, and that's permeated the entire kind of investment landscape, investment framework. So it's really a barrier to entry. As a side point, I do think that as an industry we need to keep telling the story for why we are the most responsible people to do this. If we want the minerals for transition, we are the right custodians, and we are going to deliver that in a responsible way. Then there's the separate point of kind of what you do, which is like your business structure. Like if you look at like tech, separating their base metals and their coal business, and Glencore saying that they're going to spin off their coal as well. And there it's really about do I present a clean investment proposition for my shareholders? Is there a coherent reason for someone to own this equity? And I think that allowing if you the cleaner the story you can build around what we do, to then have a proposition for shareholders, I think is something that's super important. So I think that's the two ways I see it in terms of like, how we do it, where you've got to be best in class, and then what we do, where there is a question to say, well, is this portfolio something that someone can invest in and can invest in with a simple, clean proposition? By the way, I don't think that necessarily means sort of single commodity companies necessarily, but I think there are some groups of commodities that are easier for people to wrap their head around as a standalone investment proposition than others. And by the way, coming back to M&A, also from if you think about from an M&A point of view, if you're offering paper to a target shareholder, what's that proposition, right? Have you got a nice clean piece of paper that they look at that and say, what, I already own some of this company that I love. I'd love to be part of like that bigger portfolio. Or conversely, I own this company that I love, and what, I don't really want it diluted by that.
And you mentioned divestment, like for example, coal and changing, and I mentioned earlier the changing in the regulatory discourse around mining, and maybe Mike, you can. It'll be interesting to hear from Tori's perspective, and maybe your own personal perspective, on how are these regulations really impacting transitions, or maybe driving them, I should say.
So on this topic, I'd like to focus on the foreign direct investment piece and the regulation of foreign investment. And Charles started in one of his earlier responses by saying, why, trying to understand in a successful M&A deal, why does this deal make sense? This question on foreign investment review is, if I have a deal that makes sense, is this a deal I can get done? And that's the way we look at it. And sometimes thinking about this in the sweep of time is instructive. When I started my practice in the late 90s, foreign investment review was, and this was when I was in New York and then Toronto, was something that was very rare. If you were doing a defense deal, with the military component, yes, you get that reviewed, but if it was just about anything else, it was almost unthinkable. Fast forward 25 years, and it's like every deal. You have to think about it, and particularly in mining. This is going to be something that is going to drive what M&A deals can be done, by whom, and where. And when we look at that, we see it across all of the developed countries. Everyone's heard of CFIUS in the US, Investment Canada in Canada, FIRB in Australia, similar regimes now in the UK and the EU, all looking to regulate foreign investment. And in particular, most of these regimes, including Canada, have singled out critical minerals. And in most of those regimes, copper is a critical mineral. So it's a lot of what we're talking about in terms of the battery transition. And I think the Canadian case is instructive. We had for many years an open door policy of allowing most transactions in the mining space, and that began to tighten up from 2015 onwards. Fast forward to 2022, about 1 year ago, the government brought in a new policy for critical minerals, basically saying that SOEs would not be permitted to acquire all or significant stakes in critical minerals, Canadian critical minerals companies, other than in exceptional circumstances. And we thought, what does that mean? We had done a recent transaction earlier that year, acting for Zijin, buying neolithium in Argentina, about $1 billion deal. Big questions, could that be done after that policy? The answer is probably no. Right after the government released that policy, they ordered the divestment of 3 Chinese companies from Canadian critical minerals companies, stake investments, small investments, 10, 20% in small companies. These were not headline things. So these are really important factors that drive who can invest where, and this even affects, and we're involved in a number of cases in this right now, where you have SOE proposed investments in TSX-listed companies with assets offshore, projects in Africa, projects in Latin America, not in Canada. And I'm talking about Canada here, but it's not unique. This is coming up in the US review in CFIUS, it's coming up in Australia, it's coming up in the UK. So that's really important. That is mostly aimed at investments from China and Russia these days, but it has developed another side to it. And look no further than the tech situation in Canada. And all of a sudden, on very large transactions, you have governments thinking about, do I want this to happen? And we've seen it before. We've seen it in BHP looking at potash in Canada about a decade ago. It's reared its head in the first tech transaction. So this is why we say that it's a growing issue, not just where you might think about it with foreign Asian SOEs, but actually in large deals done in Canada and other jurisdictions, almost simply because of their size. This is going to continue. And as the energy transition becomes more important, this is going to become more important. And it's going to drive M&A. And when you talk to the investment bankers, if you ask Charles, he'll say, it's not just what you can pay, it's who you are. And if I'm a target and I'm looking at different suitors, who's paying the most, who's got the best story, and who can actually get that deal done.
So are you seeing a rise in resource nationalism? You mentioned the fact that we're looking, governments are actually intervening a bit more in these deals and saying, well, what's happening here? Maybe we should take probably a closer look at who's involved in these transactions and what this means for a nation state. Is this something that we should really be thinking about for 2024, or
Well, look no further than what's happening in Panama today.
Yeah.
And over the last month in that country with the Cobre Panama mine, one of the biggest copper mines in the world. And resource nationalism is becoming, just like the foreign direct investment, quite frankly, a bigger and a bigger issue. And it is a bigger issue the bigger the project compared to the size of the country, because it becomes a focal point. And so M&A participants have to think about that, particularly acquirers. And when we're looking for clients at large transactions in other jurisdictions, particularly Latin America, in Africa, and it could be elsewhere also, a big point of what we do is work with them to figure out what are those risks. Let's identify the risks. Let's do the deep dive that Todd was talking about. Get in-country intel about what does the government think, how popular are they, who are the major players, what are the prospects for this project, whether it's developing it, whether it's operating it, to really understand what we're getting into and how we might be able to manage it. And then what do you do? I mean, you can't move the mine. So what do you do? Well, I think number one is you can be prepared and do your homework. Number two, you can look for alignment. How can you align with the host government, with the host country? Is it an equity participation? Is it a royalty arrangement? How do you make them stakeholders with an interest in the project and seeing that project operate? And if you can create that alignment, that's going to be a long-term benefit, and it's going to make you more secure. It may cost you more, but it will make you more secure. The other thing we do is we think about when we structure these investments, let's make sure that we look for foreign investment treaties. We want to invest through a country that has a foreign investment treaty with the target jurisdiction, which means that if there's an expropriation, if there's unfair treatment, we can use in Canada has a foreign investment treaty with many countries. Holland does, other countries do, the UK does. So let's do things up front by making sure we're investing, even if we have to create a company to do our investment through in one of those jurisdictions. That's going to help us. And this is where you spend a lot of time talking to your bankers, to your lawyers, to your GR advisors before you pull the trigger on a deal.
Absolutely. And you referenced Todd, so it would be interesting to hear if this is the strategy that Anglo uses or where are the discrepancies.
That is the strategy that Mike said. I mean, that when we're thinking about doing an acquisition in a new country or in a country we're currently in, is alignment, is kind of understanding, doing your homework, knowing where the pitfalls are. Also, in some sense, partnering with governments. The United States government, or the UK government, or Canadian government, as kind of I don't know if you want to say sponsor, but someone who can give you cover. I think in case problems develop down the road. Makes sense.
And it aligns with what you were saying earlier, Morgan, about jurisdictional risk, and maybe perhaps expanding how does Endeavour look at jurisdictional risks. I mean, you've built good rapport in the countries that you work on, but we can't rest on our laurels, right? So it would be interesting to hear a bit more as to how you manage that.
Well, I mean, jurisdictional risk is here to stay.
Yeah.
Mike made a good point about First Quantum in Panama, and it's sort of a poster child for the theme at the moment. How do we look at it? We roll it all the way back to its most basic components, and the core essential there is the understanding from day one that you have with the government around their stakeholder interests, and not just the government, but it's also about the local communities. It's about bringing people along with you from the first day. It's about establishing an ESG framework. It's now called an ESG framework. Previously, we called it CSR, and we called it, investing in people and making sure that people get carried along on the tide of the benefits of whatever production you're going to have, life of mine. We have very different drivers in West Africa than you have in Arizona, but there's still political risk in Arizona, right? I mean, mines don't get permitted easily in the United States, even though it's a Tier 1 jurisdiction. The difference is that we have the ability to intervene, and we have the ability to shape a little bit of our own destiny, because you're in control of your relationship with the government and how well you've found it. You're in control of your relationships with communities and other stakeholders. So there's a perception, and it's not completely wrong, on the street that political risk is just there and jurisdictional risk is just there. And to some extent that's right. But you do have the ability to shape your own franchise, shape your own story. And we're a firm believer that sharing the benefits in a sort of an egalitarian way with the government, with the communities, giving people more than just monetary benefits as well. It's about giving them opportunity. It's about upskilling them. It's about bringing neighborhoods with you. It's not just about opening a school and where there aren't enough teachers to go to where the government won't pay them. It's about thinking smartly about it. And even though we've had all of these events in West Africa, the evidence for the success of the region is the minds keep turning. We do have coups in the region from time to time, but the major minds, even to take the case of Mali, and Mali is a sanctioned country. Sanctions are targeted rather than just broad brush, but it's a sanctioned country, and if you really think about it, some of the largest gold mines on the continent are there. There's Loulo-Gounkoto, there's Fekola. They are great producers, to the best of my knowledge. They're having difficulties probably in their supply chains, choppiness, but it's not at the expense of the entire enterprise. So there's a live and let live within political risk or jurisdictional risk as well. You have to listen to what the government needs or wants.
And maybe to close our discussion before opening up to the audience, political risk, yes, but if we were to expand to geopolitical, maybe not risk, but geopolitical activities happening across Africa, but happening across maybe the mineral value chain and looking towards China, because no M&A transactions conversation can be had without mentioning China. And I think it's great to maybe capitalize on the fact that we have Charles here, who could potentially give us some insight as to where the Chinese buyers are looking towards for 2024 and beyond.
Yeah, look, I think it is a tough landscape if you're a Chinese entity looking to acquire assets or anything that's considered a critical material, which, as I think Mike said earlier, is a very long list these days. And I think the EU, the US, some of the Western players have done a pretty successful job of closing down areas that are easily accessible to them. And I think if you look at where they are acquiring assets and the price they're paying for some of those assets, so some of the lithium acquisitions in Argentina, the price that was paid for, we announced a couple of weeks ago for Khoemacau in Botswana. I think they will look broadly, and where they see opportunities that they can see a clear pathway that we can own this asset, they will make sure that they are in a position to win there. Look, I think what's really interesting about it is that and again, this is also if you look at the sort of IRA more broadly, not just about, its clear intentions to try and shut China out of certain supply chains. I think the recent years have shown that, governments really are relevant here, and when they choose to put their shoulder to it, can have a material impact on the industry, on where people invest, in terms of how they invest. And I think for sector participants, I think broadly it's a positive. There's a lot of focus on our space, and people really have woken up and care about mineral extraction and where their resources come from. But it obviously creates a real challenge. There's a lot of difficult dynamics to navigate. And to make sure that we can deliver the materials the world needs in a sort of safe and sustainable manner, but also make a good return for our shareholders while we're doing it. And the key challenge is just making sure we don't slip up as part of that. So look, it's a challenging landscape, but frankly, I'm the most positive I've been on the sector for a long time. I think we've got a really good opportunity here.
Gentlemen, thank you so much, Mike. It looks as though you had something to add.
I do have one point to add, and I think one thing has been a little bit missing in the focus and sort of the Western governments on critical minerals, and that is processing capability. We're focusing on where can we mine these minerals and get them out of the ground, but when it comes to where we process them and where most of the processing happens, not just in sort of copper smelting and the like, but particularly the battery actual turning into battery grade materials. We're slow at doing that, and until we get that part of the value chain sorted, we're going to have a gap.
Completely agree, and I'm seeing it in DRC. Unfortunately, we are at time. Apologize, everyone, but if you could join me in thanking our esteemed panelists.